When you start looking at bond or stock prices rather, you also have to remember that the prices are driven by the market, and the method that we use to predict stock prices is related to how much we know about the company itself. If we know that the projected future price and the dividend policy is known, then we can use the equation we discussed before, which requires us to calculate the present value of the future price and the dividend stream. Now, if we're looking at a company that is always paying the same dividend on their stocks, then we can quickly calculate a stock value based upon that assumption. And the formula is present value equals payment times 1 divided by R, or written another way, and that formula should also look familiar to you. It is the same one that we use to calculate the present value of a perpetuity. So if a perpetuity is a never-ending stream of cash flows, then we would have to say that if we use this formula, that the stock we are looking at must be showing that they will continue to pay the same dividend that they are paying now forever. Now, if the dividend payment is $5 and the expected rate of return is 0.07, then the present value of the stock would be $71.42 per share. Now, let's say that the same investor decides that he's not going to hold this stock forever, and he decides to sell the stock at 10 years. Now, even though the dividend stream might continue to be the same for the entire 10 years, we use a different formula. And the formula we use will be the same one that we've used before. Let's calculate the value of the dividend stream first. So if this is the value of the dividend stream, and this isn't a math class, so I'm going to work through this formula, might even skip a few steps. So if you have any questions, just get with a math tutor or post your questions on the discussion board. But we're not going to work out each step of the problem. So if we take the dividend payment from the above example and apply this formula, then the price is ultimately going to be set up, or be a little different. It's going to be set up a little different as well. So it's going to be set up okay. And ultimately, we're going to end up with, when you work all of this through, you're going to end up with $5 divided by, or times 0.491651 divided by 0.07. Now the transcript has a step-by-step on how to solve this problem. So if you need to see each step, it's in the transcript. Now we will add the value of that dividend stream to the present value of the stock 10 years from now. So let me say that another way. We have a projected stock price in mind that we will sell at in 10 years. So what is the present value of that future sales price? So we calculate that by applying the present value interest factor. So let's say that we think that the stock price will be $16. So we're going to set this up with the present value interest factor, n equals 10. And when we work through that problem, we add that amount of $18.13, which is the present value of the future sales price, and we add that to the present value of the dividend stream. And the total of $43.31 is the total sales price of that stock.